When I was playing basketball in college, we had this saying that the ball don't lie. Similarly, in opportunity zones, we have a saying that the numbers don't lie. Opportunity zones can sound abstract until you see how a real deal moves from a capital gain all the way through to a potential exit 10 years from when they put it in. Today, I'm going to break down what you need to track so you can avoid mistakes and capture every benefit. Ashley Tison here from OZ Pros. I've helped investors defer over $1 billion in taxes using opportunity zones. Let's walk through a case study together. This is going to show you how to take a gain, structure it, and see it through to a clean exit with maximum benefit, and how you dock your audit trail along the way. Because once again, the ball don't lie. Too many investors jump into OZ funds underestimating the milestones and the significance of making sure that your audit trail is tight along the way. Advisors often track the wrong things, and by the time they realize it, they're stuck because it's a real problem to go back and get bank statements when you've closed that bank account. It's a pain to get things way after the fact because it's hard to access that stuff that you need in order to make sure that your documentation is correct. The 10-year exclusion on the opportunity zone benefit, which I think is an unbelievably powerful benefit because it eliminates capital gains and it also eliminates depreciation recapture, but it only works if you stay compliant from start to finish. And let's be real, folks, the IRS is going to have a vested interest in making sure that people kept their OZ deals compliant, that they actually did them correctly, because we're talking about a massive amount of taxes that you're not going to pay. And so the IRS is going to have incentive to try to come back and undo and to really unpack what your audit documentation looks like. Choosing the deal and structuring into a QOF is part of the huge element of what you need to be doing when you're doing an opportunity zone deal. So let's just set the stage. An investor sells a $2 million stock portfolio and realizes a $500,000 gain. Instead of writing a check to the IRS the very next year on that $500,000 gain, they roll the gain into a QOF within 180 days. The QOF then drops that money down into a qualified opportunity zone business. And now they've got 31 months to spend the money from when they dropped it down. That QOZB is then going to invest in a mixed-use building inside a qualifying opportunity zone tract. Right from the start, documentation is key. The gain source, the investment date, and fund formation must all line up. So then you got to make sure that you have all of those things that document all of those specific things that I was talking about. That it was an actual gain, that it was invested inside of 180 days, that it went into a QOZB timely, that it then went into, there was a correct working capital safe harbor for the QOZB, and then that it actually went into an opportunity zone, and that you then got your substantial improvements done along the way. All of those things are necessary and that you have to make sure that you have inside of your audit trail. So, the property was purchased for $2 million. So they took the $500,000 gain and they borrowed another $1.5 million. And so, like I said before, the QOZB is going to have to substantially improve whatever the value of the building is. The rehab costs need to be tracked and documented and then capitalized properly so that it makes it easy on your balance sheet to be able to show how much over the course of time. So like every 6 months, you pull a balance sheet, you put that into your audit trail, and you can track how much your substantial improvement is tracking towards that substantial improvement bogey. You want to have that also set documentation-wise to prove how much you need to improve that building by based upon what it was worth when you purchased it. All of those things become, right, every invoice, contractor payments, every expense that you've capitalized into the deal become part of the compliance trail. So you actually get your improvement done. You get this thing rocking, right? It's getting towards stabilization, or it's actually stabilized. It's starting to spit off cash to you. And the capital markets have returned. Go figure, right? And at year 5, the QOF is able to refinance the property. Actually, the QOZB would refinance the property, and then the QOF is ultimately going to get the benefit. And because you've waited for 2 years, you're now going to be able to distribute any of the excess cash out to investors, and that is not a taxable event. It's crucial to know your timeline on that, when you can do it, how you can do it, what the mechanics are, what effect that's going to have on their capital accounts, when and how you calculate that with respect to your 8997 and your 8996 relative to what you're showing the IRS. The key thing is that you need to make sure that you're showing basis with that refinance in order to make sure that you don't trip an inclusion event. The advisors need to track the transitions and update compliance filings. And each term event, right? So each thing that happens requires you to have an audit trail associated with that. And there's nuances to the things that are going to happen about which one and what specifically you need to make sure goes into that event. Then we've hit the magic 10-year moment. Our investment in the Qualified Opportunity Fund has turned 10 years old. Wow, we can now sell this thing and we can take the step up in basis to fair market value. So we need to make sure that we document that correctly. And in so doing, right? So we put an original $500,000 worth of capital gain into it. We borrowed $1.5 million. So we have $2 million of basis in this thing, and it sells for $6 million. And oh, hey, by the way, we've depreciated it along the way and used that depreciation to offset income to make our income that's coming off of this deal even less. The income taxes that we're paying on the cash that's coming off of it. And the greatest part about opportunity zones is that on that $6 million, we're not going to pay any capital gain on the difference between the $2 million we put in and the $6 million we're selling it for. Oh, and hey, by the way, we're also not going to get hit with depreciation recapture on any of that depreciation that we've taken along the way. The key thing is that you need to understand how you now book this, both on your 8996, and then how and what time you need to distribute those proceeds within. Because failure to do so timely will result in the IRS making it be a deemed recontribution, which will now be 50% qualifying and 50% non-qualifying, which is a result we don't want to have. The crucial thing that you need to take from that is that you need somebody who knows what they're doing to help you along the way. You need somebody to walk you through how you track your improvements, how you document the refinance, how you make sure that anything that happens along the way with respect to management, with respect to any change to the waterfall, how that gets documented correctly. The deal worked, and the deal ultimately came out with a massive, we're talking potentially, we know that there's $4 million there, but we have the depreciation recapture that we did not have to pay. So we're talking potentially $4.5 to $5 million of tax-free, money that's coming out of that deal. And the deal worked because you had systems in place to capture data year after year, and you weren't scrambling in year 10. Or the smart money inside of Opportunity Zone understand that you can hold these things upwards of 30 years. On OZ 1.0, that lapses in 2047. Under OZ 2.0, you get to keep this asset for 30 years. And so 30 years of tax-free appreciation, 30 years of value is going to come out to you. But think about trying to assemble an audit trail 30 years after the fact. It's not going to be doable. That's the reason why you need to make sure that it's buttoned up along the way. A successful OZ deal is not just about getting in. It's about tracking basis, improvements, and events along the way so your exit's clean. Think of it as a relay race. Every lap matters, not just the finish line. If you want a system that helps you track every step of your OZ investment journey, try Ascent 2.0 free on me for 1 month. Ascent 2.0 is our weekly membership designed for investors, accountants, and advisors. You get live sessions with me. It's an hour and a half long. Tools that simplify compliance, significantly simplify compliance. Try saying that 3 times fast. And direct guidance that keeps your deals audit ready and positioned for your 10-year, your 20-year, or your 30-year exclusion of all taxes. It gives you clarity from day one all the way through exit and gives you comfort that you are truly creating tax-free generational wealth. This is Sherpa. Looking forward to seeing you in Ascent next Tuesday. Sherpa out.